All right. So, any questions from last week on investment? We've got not that many slides. We've got about an hour to talk about stuff. So, just like last time, in terms of any questions or whatever you've got are fair game. I pulled a couple videos that are kind of interesting for two reasons, really. One is there's a thing, and you guys may have your own preference in terms of financial websites. There's I got a lot of comments back about that Mint website. If you guys haven't checked that out, mint.com for budgeting and stuff like that. Quite a few of the video comments, people have checked that out, and they're real positive on that. And I think it's useful. You got to be a bit methodical to keep up with it, but it does help people budget and buy things and set goals and do all that kind of stuff. And then in terms of investing, and again, I'm not advocating that people necessarily go out there and buy individual stocks unless it's kind of a sort of a passion for them and they find it interesting. But for me, investing can be, well, lack of a better word, kind of boring. You know what I mean? For a lot of people, and people will spend all kinds of money on, FanDuel or whatever, sports teams and stuff like that. So my point would be you're going to allocate a certain amount of your income to investments, and probably the more stable ones, probably through whatever your employer is, going through your 401k. But if you've got other money that you're, is kind of more elective type money, rather than become an expert at fantasy football, you might want to invest that time in because a lot of people do invest for a hobby. We were talking about investment clubs last week. Some people do that. Other people will, flip houses if they have a career that allows for it. If you're a fireman or perhaps a slope guy, where you're working in shifts and, you can only, 3 weeks of sitting home, even though you worked really hard that other 3 weeks, anyway, it gets a little probably tedious. If you are going to go that direction and you're looking for something like that, the Fool.com people I think are pretty decent. And I have actually used their subscription services. But the thing about them is they do sell a subscription and they do offer free stuff, but they certainly are not a broker, or you can't buy stocks through them. You can't buy investment products through them. So, you can take or leave their advice they give you, but one thing you can say about it is they're not making money on you, trying to get you to pump and dump type stocks. The one thing they will mention, though, when they're talking about it, if they're making a specific stock recommendation, they will mention whether they have a position in that company or not, which is only fair. Because, like I said, especially if it's a very small company and you're holding a position in something, so especially like a tech startup, and if you can create some buzz and get other people to invest in it, you stand to profit a bit from that. So they will disclose if they've got an investment in something. But for the most part, in the big scheme of things, the small-time investors are just such a small percentage of the investment world that we don't really rattle things too much. Most investment is, the huge pension funds, the huge mutual fund companies that take these major positions with stocks and tend to distort the market. Do you have a question?
Yeah. Have you seen I've seen a few ads on YouTube recently, like an app that lets you check the background of new products. Like the example is, I don't know if you've seen those toe shoes that CrossFitters and stuff wear. They're they fit over your feet, they fit over your toes and stuff. So what this app does is you can look that up and you can look how long that product has been being sold and kind of where it's at, and it's made for people who want to invest. So I'm curious, I don't know, if that's something worth looking into, because I've never heard of anything that makes investing that simple.
Yeah. Well, and the problem is, it's like anything else where people are actively advertising, and I'm always like, when the guy says, I can make $1 million, and dude, if you can make $1 million in the market right now, would you be sharing that with me? Where's your motivation to, I don't think not everybody is quite that altruistic. You know what I mean? Anytime when they're like, I've got my investment secrets that I will share with you. Really? If I had a secret that's making me billions of dollars, am I just, I've got enough money? No, I don't think so. So, but I don't know. But again, I don't mean to stray into the speculation part, but for high tech things, there is a lot of collaboration that goes on out there in the internet. And we'll talk a little bit when we actually get into stocks. We'll talk about IPOs, initial purchase offerings, when a small company goes public. But that's kind of a frustrating business as well, because a lot of times, again, where we sit, we're not the dominant players in the market. The big brokerages, the companies are not really catering to us. Maybe on some small high-tech things, maybe they're using some sort of crowdfunding or something like that, and you can get an equity position. But again, that's pretty speculative stuff. But for example, like when Twitter comes out, Twitter came out a couple years ago, right? And I want to say that you get this commercial bank, and they're these big banks in New York and stuff, and what they do is they do initial public offerings, right? A company comes to them when they want to go public, and they don't do this themselves. They hire one of these big banks to kind of organize the thing, and they'll try and put a valuation on the company and how many shares are going to be sold. And with Twitter, I want to say it was like $24 or something. They decided the initial share price was going to be. And then this is where the devious part happens. You cannot buy those 24. Those shares, that initial offering was going to be given to like partner banks and people that they kind of owed favors for, because it's a pretty good deal. So when the IPO opens, the stock is actually beginning to be publicly traded. Those shares skyrocketed quite a bit. They went up to about $40, I want to say, by the time they hit the secondary markets. There's a primary market and a secondary market. A primary market would be when you're getting pretty close to buying it directly from the company. I actually do a thing where I buy, as an employee incentive thing, I buy direct shares from a company I work for, and I get like a 5% discount, which is kind of nice. Again, that's another perk. If your company has that available and you believe in the company, maybe that's something to do. But anyway, that's direct purchase, and that's a primary market. Secondary market is where New York Stock Exchange and these other exchanges, where when you're buying General Electric, you're not writing out a check to General Electric. You're buying stock from somebody else who already owns that stock, and it's all being traded in the secondary market. So anyway, getting back to Twitter, by the time it got to the secondary markets, it was up in the 40s. And then by the end of the day, it went up and down. Now it's back down in the 20s. But I used to trade it in a range from about 45 to about 70. And I did that about 3 or 4 times. So I did all right. What I do is, it was very volatile, and like I said, this one had it just didn't make sense. Twitter how do you value a company like Twitter? They don't sell a product. They had some potential, but they were having trouble monetizing it, which they still are. But anyway, it would fluctuate just on the whim of speculators. And so, I kind of noticed it was trading in a range, and I'd buy low, sell high, buy low, sell high. And you can do this. We'll talk more about this. It's semi-automated. You can put in an order when it hits, $45, boom, your sell order goes in. You don't have to sit there and watch it all day. And then when it hits $70, you can sell at the top. You can also do what they call a trailing stop. You can have a stop that's like $5 behind it, and if it happens to plummet and hits that trailing stop, boom, it sells and you're out of the market. So there's a lot of things that fairly sophisticated techniques that you can do is just a casual investor. Yes?
I know you're talking about like FanDuel and stuff, like I'm really big into football.
Yeah, there you go.
I won 300 last week.
Great.
Do you claim that on your taxes at all?
It's going to be gambling winnings. There's going to be a 1099-G at some point. Designated out there. Like, let's say you go to a casino and you win $1 million. They don't give you $1 million.
Yeah.
They give you a check for somewhat less. The taxes are withheld. FanDuel and what's the other one? DraftKings. I don't know. But the basic gist of that is it's income, and there's going to be somebody's going to get their cut. And when you look on an income tax form, whether it's TurboTax or whatever, there's a section of gambling winnings. So you'll get knocked. So anyway, back to what we were talking about. So on the Fool stuff, I'll show a couple videos. They're really short ones. They're sort of to the point, but if you have a specific question, It's like anything else, you want to fix your car, you want to do anything, the first place you go is YouTube, because somebody else has got the same problem, and you can see it, and that's why we were talking about exchange traded funds, we were talking about index funds. So I did a couple searches and came up with a couple that are close on full one. But the point of somebody like that is they're not the salesman kind of guys. They're not like, oh, you should sell everything and buy gold because we're selling gold, or you should do this and buy our product. These guys have got nothing to sell. They don't have a dog in the fight. So, and they are financial planners. They're fairly smart guys. So the advice that they give, again, it's free. So value whatever, but at least it's not biased. Yeah. So we kind of left off where we were talking about investment liquidity, and liquidity is one thing. An ability to sell is liquidity. A desire to sell, that's a whole different thing. It depends how for most investments, I'm in it for the long term, so liquidity is not so important. I'm not, oh gosh, I need to sell to pay short-term debt. So I'm not really going to be driven away from real estate because it's not a liquid investment. I can get my money back. It may take me 6 months, but if it's retirement savings, I'm not retiring in 6 months, so who cares? You know what I mean? So take it for what it's worth. Just because a investment is not liquid. I mean, the stock market's always liquid. But, again, that ability to sell is completely different than the desire to sell. The stock could be way down. Yeah, and I can sell and I can take a huge loss and, Anyway, I think sometimes some people would benefit from a little bit of illiquidity to kind of discipline them. There's a number of people, like I say, got out at the bottom of the market. They panicked. And those are the ones who lost money. People who stayed in. Anyway, we'll show that. I'll show you that chart, and it'll make more sense to you. Why does it always freeze up on me? Okay, let's go. Come on, dude. Here we go. So asset allocation, just a different, kind of term here. Several different types of investments, which lessens your investment risk. Okay, so a lot of times people will talk about asset allocation between bonds and stocks. That's within within those certain markets. But for me right now, I don't want anything in long-term bonds, so my asset allocation would look a little funny. I run kind of a broader asset allocation where I've got money in real estate and in stocks and if you want to go with some precious metals, something like that, that could also be part of it. It also can be part of it between, you can differentiate between the risk that you're taking. There's this kind of ties in the time factor and age. There's some of these portfolios that are, it's all marketing. There'll be different names for them, but it'll be life something or, whatever. What some of these mutual funds will do is they'll sort of change your asset allocation as you get older. Like I said, right now, most people should be, and the younger folks should be in growth. You should be leaning forward and kind of going for it. With the expectation if the market tanks, I'm going to ride it out. I'm not selling. I'm not retiring in 5 years or whatever. I'm gonna do that. As you get closer towards the period, say retirement, where you're actually going to be drawn out, you should probably step back from some of those growth funds and go more towards a more stable, more bigger blue chip type stocks, and maybe into some sort of income type thing. So there's a lot of variables. There's not a one size fits all. I get calls on well, not calls, but notifications saying my portfolio is way too aggressive because I'm not intending to quit working anytime soon. I'm not retiring. But they go, well, based upon I've got money in my daughter's college fund, and it's all loaded up with all these super aggressive stocks, and they're like, well, how long till your daughter goes to college? Well, she's in college. Oh, what are you doing? It's like, she's going to be in college forever. She's pre-med, so I'm looking at 5-6 years down the road. I'm not that worried about it. So, and I don't want to pass up the yields I've gotten on some of these. I sold one a little earlier this week. It was just, I put $3,000 in, and it was up to 9, so I just sold $3,000 of it. You know what I mean? At least that way I'm now playing with their money, and I was able to pay off $3,000 of her. She's in a different situation, not UAA, so the tuition is a little pricier. So I'm kidding, but whatever. You only go to college once, and I don't need a new car or whatever. I'd rather put it in something else. I mean, I've got it now. Stock and equity financing. So this is where they're talking about kind of the fundamentals of why companies sell stock. So when you buy stock in a company, you own a chunk of that company, right? And this can get, the stock is the company is being diluted a bit, as they sell more and more shares, more and more people own them. Now you will, but when you own stock, you'll get these proxies in the mail, asking you for your vote on upcoming things. Well, it's not like an election where everybody gets one vote. No, you get one vote for every share of stock. So if you got 30 and somebody else has got 300,000, you can vote if you like, but I never vote because I'm like, my stock is so insignificant. But legally, they still have to send me the proxy, just like I'm one of the big boys. So you own part of the corporation. It's not a loan. They're not required to repay anything. They're not required to pay dividends. They may have a tradition of paying dividends, but there's not a requirement. And then this common versus preferred stock. As I said, the preferred stock, they make a big deal out of it, but for me, I've never owned preferred stock, and I really don't care. I make money on stocks by capital gains, by the stock price appreciating. I don't necessarily like the income stocks because they're normally more stable, and they pay a dividend. And if they are paying a dividend and the company gets in trouble, say for like a year or two around 2007, the common stock guys will be the first not to get the dividend. Preferred have to get their dividend before any common stock guys can get the dividend. Yes?
What's some examples of common stocks and preferred stocks?
Well, just, shoot, anything I own. Twitter, there's a thing called PRAA, Portfolio Recovery Associates. Got a pretty good position with them. Lululemon, Buffalo Wild Wings. Anyway, all those are small growth stocks. But dividend stocks would be, maybe something like General Electric.
Preferred stocks is what you mean?
Well, no, stocks that would pay dividends. There's no distinction. Yeah, preferred. That's what it sounds like. Oh, these are superior. No, it just means preferred treatment in terms of paying dividends.
Oh, okay.
But if you're not in a stock that's paying a dividend, they don't even offer preferred shares.
I think maybe even one company will offer a certain amount of common stock and a certain amount of preferred stock.
Yeah.
So and then there's even other designations, and it has to do with who gets to vote at what priority, who gets to put, like at the highest level, who gets to choose who's on the board of the company.
Yeah.
Like if you buy a certain type of stock, you got to say who was on that board. If you're down to that common stock, you got to say who was on that board.
But
how much control over the company you have, how many dividends you get, who gets paid first if the company goes up.
That's the
those are
yeah.
the distinctions between what level of stock you buy.
And the voting with us, saying, I don't think we've got any billionaires in the crowd, is that it's just completely negligible. There is the teachers' pension fund of Wisconsin probably has millions of shares in whatever company, and we got 10. So a stock's trading for say $30 a share.
Stop me if I'm wrong, but if say one of us starts a business in a couple of years, and we decide to incorporate it for tax reasons,
Yeah.
we're going to deal with this. How much stock to issue? And
I've got a corporation. My business is a corporation. It's an LLC. The reason why you want to incorporate most of the time in a small business is for liability protection, right? They can sue the bejesus out of, not me, they can sue the corporation. And all they can do from the corporation is basically take every asset it's got. But they can't take my house. They can't take my, anything else that's not associated with the business. Which when you're in a sole proprietorship, you've got personal liability that's extended. So that's why most people want to go with a corporate format.
And when you do that, you have to issue stock, though, right?
Well,
you have
but
to decide which.
I just checked the block and I put 100%. Me. So I'm not doing, you could do something and maybe get a lawyer and sell shares, but most businesses, I don't think it would warrant it. Yeah.
Say 3 of us go in and make a business. I should have specified.
Yeah.
Say with 3 of us are starting a gym, and then we decide, okay, we're going to split it 1/3, 1/3, 1/3.
Yeah.
Well, if we incorporate for those tax reasons and for reasons of a lot of other reasons,
Yeah.
then we have to issue these stocks to each other, and really we'll just get a certificate or something that says I own 1/3, and that's
Yeah.
as simple as that. We're not on the market yet.
It's not a public
But, for
offering.
instance,
It's a
if I
private
said,
offering.
Hey, you two will have common stock, and I'll have 1/3 preferred stock. We still all own 1/3 of the company, but I get to choose.
Yeah.
I'm the only voter that gets to choose what the company does. See, there's control.
Yeah. Just a quick aside, there's a friend of mine, a sharp guy. He's now the vice president of Raytheon, right? He's a smart guy. Yeah, I know, he's a little stronger swimmer. Raytheon. Big boy. Anyway, he was an Air Force guy, right? But sharp. Really sharp. And they tried to promote him early, and which came with a commitment. He said, no way. I'm getting out. I don't want that kind of commitment. And he had another friend who was also ex-Air Force who opened up some biotech testing software kind of company, formed his own corporation, was getting huge. He needed more money to finance his operation, so he brought in these outside investors in the corporation. They bought up shares, these Swiss guys. And anyway, this guy's got this huge company, that's taken off. He gets in an argument with the Swiss guys. Swiss guys have more shares than he does, and they fired him. And then that's when they brought in my buddy to take over the corporation. So this guy went from being just a generic Air Force guy to the CEO, whatever, of the corporation, and then he went on from there. But yeah, you can if you give up, especially in the small realm, your voting power is equates to the stocks. But again, that's like private offerings and things like that. But yeah, the reason why most people go in corporations is not. There are certain tax advantages, but most of it has to do with liability.
That's what Mark Zuckerberg did to that's Salvarez or Eduardo Salvarez.
Oh yeah.
He said, you'll still own a bunch of stock. You have the same amount of stock, but the voting and the fact that the stock split, that kid he had owned less and less every time the stock split, every time a new round of funding went on. But
if you have 49% of the stock, you might as well have whatever. It doesn't, in terms of voting rights, the guy with 51 trumps you every time. You know what I mean? So you either have the majority, or you either, finagle the other stock. You see all this boardroom drama, and that's what they're talking about, getting the shareholders. The Apple things where the shareholders get control, and they put people in and out, and they control blocks of people who own large amounts of stock, and yeah, it's interesting stuff. Bonds, you don't own the company. Bonds are just a loan, okay? And so we went through this last week. So, like I say, you get a 20-year bond, $20,000 bond. That means you give them $20,000 as a loan, and they pay you a dividend, say 3-4% every year until the end of 20 years, at which point they give you your $20,000 back and you're done. But not very rarely, but whatever, you don't have to keep it to that length. Bonds will be traded in the secondary market just like stocks. But the purchase price or the value of that bond is going to be determined on what the current competition rate, the current bond rates that are out there being paid right now. So it's I run into this with, there's a lot of things like this that are, and that's why I'm saying 10 years from now, if interest rates go up, bonds may be a good investment again. But right now, when interest rates are historically low, they're actually talking about negative interest rates. Because they want people to get out there and invest in the economy. So the Fed's talking about negative interest rates. You put $100 in the bank, and a year from now you get 98 or whatever. So you want to keep your money in the bank? No. You should be out there investing. It's what they're trying. Again, the Fed's trying to manipulate things to spur the economy on, but it's not.
So in managing your own mutual fund that is actually owned by your life or someone else, you get to choose where your money goes. like as an individual, I could choose.
Well, you buy the bond, and then your fund manager makes the allocation,
Well,
and
a mutual fund has bonds and stocks in it, right?
could
Okay.
it can have anything. We're gonna have a whole day on mutual funds, but yeah, mutual fund can actually have real estate in it. A mutual fund can have. Anybody who says mutual funds are too risky that's a category. It's like, cars are too dangerous. There's some super dangerous cars, and then there's some, other cars. I mean, it's such a broad. There are literally more mutual fund companies than there are underlying individual stocks.
But at this point in time, because the interest rates are just,
Yeah.
if I was going to move my money around, I wouldn't want to go with something that has a lot of bonds in it.
Right, not long-term bonds. Short-term bonds might be a different thing. Short-term bonds would be bonds that I give you $20,000 now. We pay you whatever interest, and 3 months from now you get your $20,000 back. So your exposure to changes in interest rate are significantly less. But if you're making a bet 20 years out that interest rates are still going to be this stupid low, then that's not a bet I would ever take, especially when you're starting at zero. I mean, yeah, they can go negative, but that's kind of a gimmick. I don't anticipate them to stay there. But they've been zero in Japan and other places before. It's kind of weird. But we're in kind of uncharted territory in terms of some of these interest rates. So mutual funds. So we finally going to explain them. So investors' money is pooled by an investor or professional fund manager. That's what they're talking about here is really an actively managed fund where somebody is going to get in there and change it. It could be more of a passive management strategy where they're just going to buy into an index. The S&P 500 is made up of 500 stocks, and they're going to buy, whatever dollar amount of the whole indice and not ever trade. That's an index fund. So very low management fees, very low things. But anyway, what they're talking about is invested by a professional fund manager. It doesn't necessarily take a professional fund manager to establish an index fund. You buy shares in the fund, so you buy them just like you're buying stock, but you're buying a combination of stocks or a combination of investments. It does provide diversification. Again, if you think pharmaceuticals are going to go way up and you buy into some wonder drug, and it turns not to be, the next whatever for cancer, that's a pretty speculative investment. But if you buy into all pharmaceuticals thinking that, hey, there's potential somebody's going to hit on it, and now that you own that whole sector, and you can do this anyway, sector funds are just one thing, Conservatives are extremely speculative, certainly. Match your needs with funds objectives. Be aware of fees depending upon fund and fund chosen. So again, the big gotcha with that is actively managed funds are going to have higher fees because that guy, he thinks he's some rock star trader. Plus, he's more involved, so his fees are going to be higher as opposed to an index fund where the fee should be rock bottom low. And then the other broad classes of funds are no load funds and loaded funds. All mutual funds are going to have an expense fee, but some actually have an upfront charge. And like I said, there's really no valid reason at this point to be paying a loaded fund because there's so many on the market that aren't loaded, and you don't need that. Since this whole thing is kind of broad investments, real estate, they're going to put in here. They're talking about 3% appreciation prices average. However, decreases in value are also possible, location. So anyway, the big deal about this, I was talking to my neighbor last night. He's got a daughter down in Arizona. And he's like, yeah, I can't believe it. These guys, these homes were going for, $30,000 and now they want $150,000. And that's within the span of a couple of years, right? The Alaskan market's not like that, but Arizona, Phoenix, the Gulf Coast in Florida, well, any place in Florida, especially Miami too, there's certain areas that are just incredibly volatile. So that's one location factor that, if you want that kind of volatility, go for it. But I'm not up for that. Like for example, the home I have in Germany, there it's just static. It doesn't. There's very little speculation. People stay where they're at. There's no urban sprawl. It's very predictable. The other thing about this 3% appreciation too, that doesn't sound like a lot of money, but like I said, in real estate, it's very common to leverage, right, where you're using borrowed money. Most of the time, you don't actually own that whole house, so you may be, like we used in that example, controlling a $300,000 home with maybe, say, 30 grand, 60 grand, something like that. So, you're making 3% on 300,000, which is what, $9,000 bucks. So, and if you've invested 30 grand and you're making $9,000 in interest on it. Anyway, you also are paying interest on the loan that you have outstanding. So there's a couple more moving parts. But anyway, real estate can be pretty profitable. The big thing though on local areas with location is there's certain. I've got a real estate license here in Alaska, and just from common whatever. I've owned homes in Spain and pretty much all over the U.S. But the key to location is kind of being on the edges, on the edge of a golf course, on the edge of a lake, on some sort of waterfront, perhaps. Just that's where things tend to appreciate the most.
On the edge of bankruptcy.
No, not at all. Nah. Well, yeah, you can do that, but again, that gets into speculation. And once in a while, people hit on one of those, but there's a lot of people out there sniffing around looking for foreclosures. You never want the nicest home in the neighborhood. You want to be kind of, you want location. I'm always more of a location person in terms of I want to be in the best area. But if you're driving down the street and there's one house that's mammoth compared to the other homes, that's probably not going to be the best investment. That reindeer I had when he was loose, oh my God, he had pretty good taste. We're out there in Eagle River, and she said, "Oh yeah, it's the big brown stucco house down. Go beyond the gated thing." I go up there and it's like, holy! I mean, we're not talking $1 million home. We're talking multi-million-dollar. Perched out there, I'm walking Rowdy the reindeer out around this place, looking around because it sits out there. I mean, it's just that house will do very, very well if there's people in the market for that.
Cameras following you around.
Yeah, no, the lady was inside. We were talking on the phone. But there's also horrible investments in real estate. There's, especially with the internet now. There was a 6-acre piece of property I was looking at over on Highland, complete avalanche zone. It was disclosed, but just the same, you might buy it on it. There's another home that they aren't even marketing it right now. It's vacant, but again, it's an avalanche zone. You can't get a loan for it. So how many cash buyers are there? Not many. There's another home I looked at. This is where I brought out the professional engineer to do the inspection because it was going for a great price. It was out on Mirror Lake, but it's basically sinking into the sand. And you had to, the septic tank would not work because the water table was so high. So you'd have to have the, sump pump guy or sewer pump guys out there monthly, so you can pretty much add $250 on your mortgage every month. I mean, there's some minefields out there. I'm not an agent. If somebody came to me and, I don't necessarily like the caliber of people you deal with in that business, so I'll probably never get back into it. Plus, you need to hit a certain amount of critical mass. You need to be actively involved if you're going to be successful in real estate. But if I were buying a home, I would just about always use a guy who's active in that business in terms of rather than a for sale by owner. A lot of times for sale by owner things are overpriced, and then the paperwork doesn't quite get done right, and it just real estate's already kind of sketchy enough. The lady I used when I actually purchased the home up here before I had my license, she saved me a tremendous, because I was looking over on Highland Drive. You guys familiar with Eagle River? It's kind of gloomy over there right now. It's pretty much dark. I mean, it's a beautiful area, but it's in the shadow of the mountains. The sun will not come up till March over there. So anyway, that's something to know if you're, new to an area looking around. So I would caution you on that one. Before you buy real estate, well, yeah, this is so hard to determine. The competitive price, they're going to have to do an appraisal, but the whole appraisal system's sort of a joke. The appraisers know what your loan value is. They know what the home's being sold for. They'll find comparable sales, and it's not necessarily a test of the value. Financing, yeah, interest rates will have a huge impact. If you look at the interest rates, quarter of a point on interest will definitely affect the market and have a great effect on your the amount of the home you can afford. How much of the taxes? That's easy to do. You just do a public search, and tax records are public domain. So condition of the building, the house's immediate area. So there's a lot to it. You want to know the area. You want to see it at different times of the day. There's a lot to it, and most of the time, the agent that I bought that home from, she had actually sold it once before, so I was pretty solid. I don't know that I would trust, present owners. Who cares really why they're selling?
You mentioned different times, seeing it at different times of the day.
Yeah.
Which is important. With the traffic that goes by.
Yeah.
And the traffic at night, perhaps. And also in the summertime versus the wintertime. In the summertime, you can see whether or not that pea gravel roof up there is falling in, or just destroyed. And the lawn. If there's big dips and holes and stuff that might cover up the snow.
Yeah, I mean, if you have the time, especially if you're buying a local area. But yeah, that's why if you're a lifelong Alaskan and you are buying just a few blocks down the street, then maybe that's you can do this on your own. But for a lot of times, and there's certain things you aren't going to be able to factor. Like in the month of June, mosquitoes just own my property. You cannot go in there because it's basically a big swamp behind me, which is good. I mean, they call it wetlands to make it sound more attractive, but it provides a boundary for me. And in the winter, it's awesome. The horses can go out on it, the rest of it.
My grandpa ran into that down in the Keys. He bought an entire Florida key in the 70s. Like I was small island, 10 acres or less. So he owned one and some parts of other ones, and was like, all right, this is going to be great because subdivisions were going in.
Yeah.
Things getting dredged, and you had these canals so that you could get your boats out to the open ocean. And then, Federal Wetlands Act.
Exactly.
All the keys became wetlands. You cannot develop on anything. So that's another thing to look out for, especially.
Oh yeah.
Wetlands, I don't know, that's the one I know the most. But yeah, the federal government came in and said you cannot, your land is now completely useless. You can't so much as put a no trespassing sign up.
Yeah.
You cannot alter your land in any way, and now the land is worth nothing.
Well, there's a piece of property behind me in the Eagle River. Again, it's being sold for cash because nobody's going to loan on it. It's $500,000 for 80 acres, but it's a swamp I'm talking about. And if you do anything to it, you have to go to the Corps of Engineers. You have to pay what they call mitigation, which means you have to give them an equivalent sum of money for them to buy property someplace else to replace this wetlands that's going to be converted. And then you got wetlands. So it's going to take a lot of dirt to get that even usable. And then you're still going to have, it's just some of those things. I've got property down in Florida. I think they finally got it solved, but it was like 12 years where it was stuck because of the beach mouse. There's a little beach mouse, and my real estate friend down there is just, I can't do that, beach mouse, beach mouse this, beach mouse.
So
right.
So the
specific one.
The corollary to that is the people who already own developed land there want that to happen because then the price of land, which can be developed on because it's grandfathered in, goes up. So they're now lobbying, hey, let's protect the beach mouse.
Yeah, exactly.
Suddenly their piece of property is tripled, quadrupled in value because you can't buy any more property in the area.
Yeah. Well, and I think we touched on it earlier in this thing. I mean, there's and real estate can be a minefield, and for me, I'm just telling you, the for sale by owner. Usually things end up for sale by owner because somebody will go, I want $350,000 for this home, and the real estate salesperson will go, dude, there's absolutely no way. And so the person gets insulted. Well, I'll sell it myself then. And so they're still asking way out of market value. It can happen the other way around, but typically it's this direction. And the real estate agent they've got a license, and the laws in Alaska are super strict in terms of disclosure. And so if that agent knows about something going on and doesn't inform you, they can get sued, they can lose their license, they can get hammered. So you know, there is some assurance. I mean, like I say, they're not the kind of people I'd want to deal with, but they're usually just kind of jerks to one another. Usually towards the customers, everything's kind of typically friendly, but they will stab each other in the back for, you know, it's whatever. Is anybody looking at going into real estate, property management kind of stuff? Property management is probably not as bad. Real estate, though, as a salesperson, it's just a tough gig. Let me just tell you, there's 5% of the people make all the money, and there's these other 95% of the people that pay a lot of fees and are just kind of hanging out. But those 5% of the people, you know, they're maybe making, you know, in excess of $300,000 each, and they don't, you know, there's no fallback plan for a lot of these folks. So if you start to, you know, jeopardize one of their deals, man, I mean, they go off like a caged animal. At least that was I hear this daily from a friend of mine who's still in the business, and he's always, because he came from an Army background, and he's not used to, you know, people trying to throttle each other on a continual basis. Can property decrease in value? You bet. Other investments, yeah, you know, antiques, collectibles, calls, derivatives. So we talked about call and put options. This is, you know, options where you're part of like futures trading. Derivatives, that's what derivatives mean. They derive their value from something else. So it violates that whole thing I was talking about with, like, you know, Warren Buffett, where you only invest in things that you can reach out and touch. People are buying these mortgage-backed securities, and their value was derived from, you know, these you know, great homeowners out there. Well, they weren't great homeowners. They were speculators who, you know, most of them were ninjas, no income, no job. They were just going for it, and when the market collapsed, everything collapsed. Commodities, yeah, pork bellies and, you know, orange juice futures, and it's probably nothing we're doing. Coin stamps, I'd just be too. Same thing with gemstones. I'm not smart enough to know a counterfeit from another. In precious metals, the track record is not what we're looking for. Let me see what else. Let me check something, because I want to get to these couple videos that I brought in, because we talked about the investment plan. Yeah, okay, we'll still go there. So, realistic goals, you know, this gets back to the start. We've been talking about this the whole time, how much you need realistically in a nest egg to get by. Choose at least 2 different investments. I don't know that I would necessarily come up with that. You know, I would you're going to ease into this as you begin to build wealth. And at a certain point, you might want to look towards a certified financial planner if you don't feel like you've got, you know, the skills. Or even if you feel like you have the skills, there's, you know, nothing wrong with coming up with your plan and having it validated by a third party who's, you know, disinterested and, well, interested, but only interested in you. He's got a fiduciary responsibility. He's not trying to sell you anything. Factors to reduce. Yeah, keeping track. Tax consequences when you do get to sell. You know, especially if it's real estate, that's kind of a no-brainer, especially if you're living in it. You know, living in it right there at the 3 out of the past 5 years to escape the capital gains on that. On the and when you're starting to sell shares, you know, look at the rest of your income, and you might want to spread it out over a couple tax years to minimize the bite the IRS is going to take out. Investment information. Yeah, Value Line and Morningstar are pretty good. Yahoo, I like Fool, but Yahoo and CNN, a lot of times you end up kind of chasing past performance. You know, you're interested on what this company's going to do in the future, not what they did, you know, last year. If they had record earnings last year, does that mean, is that indicative of future performance? You always hear that statement, you know, past performance is not indicative of future whatever. That caveat, because a lot of times, if you're picking them from Yahoo and money, that may happen. Let's look at this one. So this is what I was talking about. This is the Dow Jones Industrial. So this is the Dow, when they're talking about the Dow. And this, you know, granted, individual stocks are going to matter, but the Dow is an indice, right? And so you can see, you know, sort of some pivotal times. When they talk about the Great Depression, yeah, it was pretty great, you know what I mean? But if you sold right here, yeah, you got absolutely clobbered. But if you were, even back then, were a smart investor and were in it for the long term, you know, this was, you never quite got back up to this period until in the 50s, but within a few years, what was that, 2 years, 4 years later, you were almost there. In more recent times, here was the split back in 2007, 2008, there on the chart. And you can see those people who sold at the bottom, yeah, they got clobbered, but if they would have waited, you know, within a couple of years, they'd be back up. I mean, the returns that year after the drop was like 43%. Now, the only way to get that 43% would have been to jump right in at the bottom. But for most people who just rode that burble out, you can see where the graph ends up on the chart. And this chart only goes to, what is that, 14. But just the same. That's, yes?
Well, I'm just kind of looking at, I don't know if anybody else had use of the stocks on their iPhone.
Yeah, certainly.
Yeah, I was just curious what all this means. So, here the zero stock is the Dow Jones, and it's got 17,863.43 What is that?
That is where the Dow Jones is right now, which would equate to the right side of the stock. And I'll actually pull up that app because it's kind of useful. What I'm more interested in, I'll find a way to get that app on my phone. I mean, on the screen. But you can basically tap that, and you can get a chart from one of those. So if you tap the bottom thing, you'll be able to derive the chart out to like a 3-month or a 6-month. And then also, for example, when that one stock was dropping last week, and you want to know what's going on, you tap that, and it'll give you the recent news related to that stock.
On that spike just before the Great Depression era, that spike is due to the government overinflating bonds. Isn't that right?
There were a lot of factors.
$100 bonds for
Yeah.
$70 or whatever.
Yeah.
And then they weren't able to pay it out at the end. And that's why it drew it down further.
Yeah, I mean, people, you know, what was his name?
What they're doing today?
What's that?
I know what they're doing today.
Yeah. I mean, we're setting ourselves up for another one. It's going to be cyclical, but that's why, if you're in the long term, you know, let it do what it wants. You're dollar cost averaging. You're buying, say, $100 a month, and so when it drops like that, you buy more shares. You know, you're still buying $100, but that $100 will now buy more shares. And when it goes up, and so these burbles, you're a long-term guy. You should be for retirement.
Well, I see it. You know, the GNP is never going to drop down to where it was because we have so much more product out there.
Yeah.
So much more demand and so many more people. But how far will it go? You know, back down at like,
Well, they talk about corrections, right? Corrections are typically 10%. But when the market's trading for like 1,700, you know, that's 1,700 points. So, and in a typical correction, there's no rules. I mean, it can drop quite far. But people still got to eat. People still got to take medicine. People still got to drive cars. I mean, not all the companies can go out of business. But corrections will happen, and they'll be about 10%, typically. And there's so much, people, it's a 7-year cycle. That's how it works. Oh, and it always drops in October. Maybe. You know what I mean? There's no absolutes. Here's a couple of these videos. Let me see. So this is just one of the full ones.
Hi everyone, my name is Matt Argersinger. I'm an analyst at the Motley Fool. As part of our Ask a Fool series, Stephen Schaefer asks, mutual funds have crazy expense ratios. Index funds supposedly give good exposure with minimal ratios. What is the reality with index funds?
Okay, here we go.
Stephen, that's a great question. The reality with index...
So this is Motley Fool.
Hi everyone, my name is Matt Argersinger. I'm an analyst at the Motley Fool. As part of our Ask a Fool series, Stephen Schaefer asks, mutual funds have crazy expense ratios. Index funds supposedly give good exposure with minimal ratios. What is the reality with index funds? Well, Stephen, that's a great question. The reality with index funds is, yes, they are generally cheaper, have cheaper expense ratios than mutual funds, simply because index funds are passive investment funds. They essentially follow an index or a specific industry or sector and aren't making active investment decisions like mutual funds. Now, some investors want to pay up for mutual funds because they're paying up for active managers who are actively buying and selling stocks, making bets, taking risks, changing exposures, and some believe that can lead to better returns than your average index. The proof is that most index funds actually outperform most mutual funds. So not only are you getting, are they cheaper, but you're getting more bang for your buck because they're generally giving you better performance over time. So generally, index funds are a good thing, but if you do want to take a little bit more risk and see if there are active managers out there that can beat the index, maybe you're willing to pay up for a mutual fund instead. Great question. If any of you out there have more questions, please come to our website or email us at askafool@fool.com. Fool on.
So those guys try and make it, a little bit more entertaining in their whole Fool thing. What the guy's basically saying is that there's been a number of studies done that have said that, these guys who are out there, consider themselves great fund managers, are actually doing more harm than good a lot of times. They're buying and selling and trading and stuff. And a lot of times when a market's going up, you're better off just to stay in the market, buy an index fund, have a position in all these stocks, and just leave it. Don't trade it, and the market goes up. And so they've done a few studies to show that all but a few of the more skillful managers, for all this effort, are actually coming up with a lesser return. And then you combine that with the fact that these guys are also, because they're putting in all this effort, they're also charging a higher management fee, and they're running higher expenses for all these commissions and stuff for buying and selling. So right now, index investment type things are pretty popular. Will that continue, or was it just an anomaly? Who knows? But the thing is that if you're doing your own investing and you're using an index fund, that's one thing. But you always need to be looking and see if the grass is greener someplace else. And if there is, the next Warren Buffett, Berkshire Hathaway, the phenomenal returns. Huge management fees charged, but who cares? I'm making lots of money, and he deserves every dime he's getting. You know what I mean? If it's one of those guys, but if it's somebody who's charging you excessive fees based upon his performance, then ditch them and either go with an index fund, which is just a buy and hold strategy. They buy the entire index and just hold it, or get another actively managed fund. They also have exchange traded funds. That's just a different concept. But this isn't the end. This is just supposed to be investing introduction right now, investment fundamentals for this week. So we're going to have a whole thing on mutual funds. And we'll have, more on real estate. So we just kind of, set the table here. We just sort of looked at everything, but we didn't really go in. We did kind of go in the weeds on a few things, but it's all good. It's kind of a broad exposure. But if you've got more questions or specific ones, bring them up next week and we'll get to them. The homework, yeah. One thing. So. This last one, not in the textbook. Choose 3 mutual funds that you would consider investing in. State the reasons for your choices. Further analyze your choices next week. So you can go to anything on the internet, basically. Whether it be Fidelity or T. Rowe Price or you name it, American Century. There's tons of mutual fund companies out there, and look at their stuff. When you want to buy a mutual fund, you just can't buy it. You have to acknowledge, kind of what their trading goals are, what the rules of the road are, all that stuff. It's specified in a thing called a prospectus. So you have to have a prospectus. And so there's what you're looking for when you go to these mutual fund companies. You go, oh wow, yeah, I want to invest in this Chinese fund. And then you look at the prospectus and you look at what the rules are, and it's going to sort of tell what that fund manager can do. This fund will invest primarily in only Chinese, equities. The fund manager may hold other positions, but only for a short. I mean, it's got some constraints on there. And then if you are good with all that, then you acknowledge the prospectus, you invest some money or deposit some money, and then you're off to the races. So it's not hard to do, but at some point there's going to have to be at least an electronic signature that you've acknowledged the read the prospectus. Questions?
Is that on Blackboard?
Yeah.
Okay, it wasn't this morning.
Oh, it wasn't. Oh, okay. I'll sort that out right now. Okay. Good.